what does it mean for investors? Well, the market is one indicator of what a company is worth. So people actually said Apple is worth less because of what they're coming out with their products. This Apple iPhone X is going to have to sell a lot of units for Apple to maintain its dominant position as really one of the largest companies ever in the world. And part of that company was built on the largesse of its founder. And this is not the only story, again, tie in to Henry Ford. Ford Motors is a story about Henry Ford, in large part because it takes individuals to create corporations. This idea of a separation of ownership and control, it's an ideal. Is it a reality? Do corporations really have a separation of ownership control? And if they do, if there truly is a separation of ownership and control, then why do corporations get constitutional rights of individuals? And if there's really not a separation of ownership control, why do they get limited liability? And how do we want to address those, right? Those are some of the big kind of framing issues here. Big topic stuff, big picture stuff. Why do corporations exist? Why do we allow them to exist? There are two main views. And one is that we allow them to exist because by having this vehicle to create profits, we allow capitalism to move quicker. And capitalism is a process by which we move resources from a place of lower value to a place of higher value. Capitalism is a system of voluntary transactions. That's how it's often distinguished from other regimes of central control, right? If I want to buy a laptop, I'll go to a store and I'll look at the laptops. And if none of them seem worth $1,000 to me, I don't have to take out my wallet and spend that money. If I buy a laptop for $1,000, assuming that I'm rational, we'll come back to that assumption, at least in my case. Assuming you're rational, you go to the store and you rationally want a laptop and you look at them and you feel like there is one out there that is worth the price tag on it, right? You all felt that way when you purchased your computers, or you would not have purchased them. Would have purchased something else. Meanwhile, it was worth someone selling it to you. So we had a voluntary transaction, and that meant that that laptop was worth more in your hands than in the seller's hands. So in doing so, in buying that laptop, you allocated goods to yourself and money to a company that they can use to create other products, and in this way increased welfare. You were better off. You were better off because of this transaction, or you would never have entered into it. So maybe corporations exist primarily because they help facilitate these transactions. By creating limited liability, we can take risks to develop more products, we can centralize capital, we can organize management, we can have specialization of labor within a firm. We don't have to invent all new contractual relationships. We take them off the shelf thanks to Delaware General Corporation Law or whatever law we want to incorporate under. But there has been a long-standing debate, a debate that goes on to this day about whether corporations also, or first and foremost, have a social responsibility. This debate has gone on at least since 1929. Does anyone know what happened in 1929? Joe? The stock market crash, was it Black Friday or Black Wednesday? I forget the day of the week, but it was black, and meaning really bad day. It had a really bad day, and there was a run on banks on Black Day in ENY, and as a result, the Congress decided they were going to pass a bunch of laws preventing such a thing from ever happening again. And one of my theses, and you'll see in my research, is that this is often how financial regulation works. We have some kind of crisis, and the government says, never again. We're going to prevent that crisis. We're going to have committees and a process and create a number of laws. And they created a number of laws governing corporations and the way they raise money to prevent another crash. And this sparked the debate on corporate social responsibility. Historian Lynn Stout writes in her lectures and commentary on social responsibility a discussion that existed between, on the one hand, Adolf Berle, and on the other hand, Merrick Dodd. And we'll talk about the Dodd-Frank Act a little later, but one of my favorite laws, I'm being sarcastic, one of my most problematic laws, named after this individual who actually vehemently disagreed. So a couple quick quotes here. So Berle argued for shareholder primacy. Shareholder primacy is the view that corporations exist to make money for shareholders. That is their sole purpose. And that all powers granted to a corporation or to management of a corporation are at all times exercisable only for the ratable benefit of all shareholders. Again, the shareholder primacy theory, corporations exist only to make money for shareholders, and that their powers are granted to management only for the financial pecuniary benefit of shareholders by increasing stock value. So did Steve Jobs perform his task when he released the iPhone 8 Plus along the iPhone X? Well, fortunately, we have the business judgment rule, which says we can't sue. Sorry, not Steve Jobs, resurrecting him from, Satya is.
Because Steve Jobs hasn't done anything but hold it down.
Not in a while. Although, well, there's still kind of. I mean, the iPhone was his brainchild. They're still sort of writing off of that. I don't remember who made the announcement. Tim Cook, of course, though, was the new CEO. And so, did Tim Cook fulfill his managerial obligation by spearheading this? In fact, would we even say that since the stock price went down, is Tim Cook liable for a lawsuit? So the stock price went down, right? So that shows, at least the market believes, that Tim Cook did not necessarily increase shareholder value by releasing 3 iPhones. Might have been too expensive, might have created confusion, might have had supply chain issues, not sure why. But there's some evidence of either mismanagement or an error, a judgment error. Can we sue Tim Cook? There's a doctrine that speaks to this.
His shareholders could. That's one of their 3 rights.
So the shareholders can sue, right? One of the fundamental rights is to sue. Maybe I should ask, are the shareholders likely to prevail on such a lawsuit?
No.
They're not likely to prevail because what is the rule? What is the fundamental principle that would prevent the shareholders from winning such a lawsuit? Yes. That's right, Jake. The business judgment rule, right? What is the business judgment rule? That when directors acting in good faith, with enough information, enough time to process the information, make a business judgment. I don't want to say they're impervious to suit. We're going to see the boundaries of that next term when we talk about it in more detail. But we want directors to take risks. And what happens with risks? Sometimes they go wrong. You're allowed to make mistakes. In fact, you're encouraged, if you are going to be sued, if you ever make a mistake, you're not going to take risks. Shareholders can diversify their investments. If you're just invested in Apple, you're foolish. I mean, that's proven. You should be invested in a wide range of companies. Remember that chart? We want to reduce our idiosyncratic risk by investing in a portfolio of companies. We can divest away some of the risk. We invest in companies because they have risk, because Apple's going to take a chance. And you know what? They might be right. We don't sue him now. The iPhone X hasn't even been released yet. Maybe it will be the next thing. Maybe it's part of a larger strategy. Maybe there's something we don't know. Now, on the other side of the debate, however, was Merrick Dodd. Merrick Dodd disagreed with Burrell's shareholder primacy, and he argued for a view of the business corporation as an economic institution which has a social service as well as a profit-making function. Meaning that directors were authorized, now again, under Burrell, what are directors authorized to do? Increase shareholder value. That's it. According to Dodd, directors were also allowed to secure jobs for employees, produce better quality products for consumers, and contribute to the welfare of society as a whole, that they were inherently authorized to do that. Milton Friedman followed after Burrell, and he spoke against Dodd. He said, "When I hear businessmen speak about the social responsibilities of business in a free enterprise system, I am reminded about the wonderful line of the Frenchman who discovered at age 70 he had been speaking prose all his life." I have no idea what that comment means. I guess it means it didn't make sense. The businessmen believe they are defending free enterprise when they claim that business is not merely concerned with profits, but also promoting social ends, that business has a social conscience. In fact, they are, or would be if anyone else took them seriously, preaching pure and unadulterated socialism. Businessmen who talk this way are unwitting puppets of the intellectual forces that have been undermining the basis of a free society these past decades. Their discussions of the social responsibilities of business are notable for their analytical looseness and lack of rigor. What does it mean to say a business has responsibilities? Only a person can have responsibilities, and corporation is an artificial person, and in this sense may have only artificial responsibilities. The doctrine of social responsibility, he puts in quotes, taken seriously would extend the scope of the political mechanism to every human activity. It does not differ in philosophy from the most explicitly collectivist doctrine. I have called it a fundamentally subversive doctrine in a free society, that there is only one social responsibility of business, to use its resources and engage in activities designed to increase its profits, so long as it stays within the rules of its game, which is to say, engage in free and open competition without deception or fraud. So now we have this even more striking perspective. This is Milton Friedman now in about 1970, arguing that corporate social responsibility was tantamount to socialism. And in fact, as he argues in other work, that a policy of corporate social responsibility would in fact decrease social welfare. And Neil Karnani took that up in his recent Wall Street Journal article, The Case Against Corporate Social Responsibility, which I suggest you read, and I'll post on Blackboard. Now, the problem with Milton Friedman was he might have been a little too smart for his own good, in the sense that he believed that humans were as rational, not only as he was, but as rational as one might idealize. The capitalist system, the argument that I've advanced and that I will to a certain extent stick to, that people engage in voluntary transactions only when they will both become better off, is based on the idea that people are rational, that they understand what they want, that they know what their options are, that they can value things properly, that they act reasonably. Delaware Court Chancellor William Allen described Milton Friedman's view as incomplete. Now, Milton Friedman, by the way, was one of the architects of law and economics, at least the original first wave of law and economics out of the Chicago School. And I will introduce law and economics comments throughout this course. It has been changed, watered down to a certain extent as time goes on. We've introduced through Richard Thaler, who works on behavioral economics, the aspect of irrationality. You might have seen some of this. Mountain Gladwell talks about some of these economic theories. You might have read Freakonomics. So this has become a little bit more in the public conversation, but we're still in the 1970s is the very beginning of a new way of thinking. Anyway, Chancellor Allen disagrees. He says, the law and economics paradigm offers a highly coherent conception of corporate law as a system of rules facilitating wealth maximization. This is, to an extent, an idealized version of corporate law in action. Now remember, this is someone who sees real cases. Instead of the theorist, Milton Friedman was an economist. I'm not so sure how many actual corporations that he worked with. He was dealing with ideas, right, and mathematics. Now we have an individual who's sitting in court talking to people who has seen the people on both sides, the plaintiff and the defendant, the management. Like much of neoclassical economics, the law and economics of the corporation is at bottom not empirical description but normative prescription, meaning it means to tell us how people would act with respect to formation of legal rules if people acted rationally. The idealized law and economics version makes a tremendous contribution to our understanding of the nature of the firm, but it is not complete. My own understanding, Chancellor Allen's, which I confess is incomplete as well, acknowledges the power and utility of much of the law and economics story, but recognizes as well the pressure on rule-creating agencies to view corporate directors as men and women with obligations of loyalty, which will be evaluated on ex post on a fairness standard. Courts have felt and responded to these pressures for over 200 years. To whom director duties of loyalty are owed can and has sustained earnest debate in legislative chambers, in the press, and in the academy. And here he's saying, do directors owe loyalty only to shareholders or to society as well? Thus, either a descriptive or a normative account of corporate law that I might advance would include a powerful element of wealth maximization, but it would inescapably include as well a political, moral component. Corporate law is a system of rules, principles, and roles, and a process by which they are defined, redefined, and legally significant interactions and enforced. In that process, the law or legal agents mediate, pursuant to the process of law, between the wealth maximizing value and the ex ante analytical style of the liberal model and fairness and the ex post analytical style of equity. Again, courts in Delaware, the chancellor of the court in Delaware is saying, I will allow for equity and fairness in my management decision makings in courts that I hear.